Hey guys, in this video I'll be analyzing Raytheon Technologies Stock, ticker symbol RTX. Their most recent acquisition of United Technologies will be discussed, along with their financial health, operating performance, and dividend safety. At the end of the video, I'll be ranking the attractiveness of the stock on a scale of 1 to 10 from the perspective of a dividend investor, so make sure you watch all the way through. I wanted to do a brief channel update. Now, I will be posting a poll in the community tab of my channel, so instead of voting in the comments like usual, make sure you're subscribed so when I post a poll, you'll get notified, or you can go to my channel to check it out. And if you want to get your stock in a future poll, then leave a comment below. These videos take a lot of time to research and produce, so if you guys enjoy the content and want to help the channel out, make sure you hit the like button and share the video with your friends. It's all appreciated. And with that, let's jump into the analysis of Raytheon Technologies stock. Raytheon Technologies Corporation is an aerospace and defense company that provides advanced systems and service for commercial, military, and government customers. They are the result of a merger between Raytheon and United Technologies that was finalized in early April. Now, for a lot of this video, I'll be reading from and giving my take on a recent article on Forbes, 5 Reasons Raytheon Technologies is Destined to Dominate Aerospace and Defense. If you would like to read the article for yourselves, it will be linked in the description below. So the article begins by giving a little background on the two companies, but we'll skip past that for now. They say, the newly minted Raytheon Technologies, stock symbol RTX, really will transform the aerospace and defense landscape, becoming a dominant global supplier to military, commercial, and civil customers. To grasp why surprises like the coronavirus pandemic will not be able to hold it back, analysts need to understand the new enterprise's 5 core features: scale, focus, depth, diversity, and resilience. So let's see their rationale for each of these core features and if these will matter moving forward. The article starts out with scale. United Technologies already was a big player in defense before the merger, thanks to the defense electronics work of Collins Aerospace and the growing military footprint of engine maker Pratt & Whitney. Raytheon was one of the biggest military contractors in the world, selling missiles and sensors to all U.S. military branches and many overseas allies. Now, these claims are true. United Technologies in 2018 had $67 billion in revenue, and Raytheon alone produced revenues of $27 billion. And according to M1 Finance, they're the 4th highest valued industrials company in the world, only surpassed by Union Pacific, Lockheed Martin, and Honeywell. The article goes on to say, when those military lines are combined with the robust commercial portfolios of Collins and Pratt and the merged enterprise, what emerges as the 2nd biggest aerospace and defense company in the world. With $74 billion in pro forma, or pre-coronavirus, sales, Raytheon Technologies isn't just big. It's the number 1 or number 2 global supplier in most of its addressed markets, from jet engines to radars to cockpit displays to ejection seats to missiles. Now, if you guys follow the channel closely, you know that I recently did an analysis on Boeing stock, but if you missed it, you can watch the video after this one. In that video, I talk about why aerospace and defense is such an attractive industry, mostly because of the United States' track record when it comes to military spending. I also don't think this should be too heavily impacted by the current pandemic, which is why I like that part of Boeing's business model the best. And that is all this company does. Scale in this industry makes it very difficult for others to compete when it comes to production costs because they benefit from positive economies of scale, which basically means that if you make more of a product, your average cost per product will be lower than somebody who makes less of that product. So this is definitely a valid point for why this company is going to be strong moving forward. The next key factor that the article points out is focus. Despite its complex portfolio of products, there's an underlying unity to the competencies of the merged enterprise. In the simplest terms, Raytheon Technologies is an electronics and propulsion company. Moreover, its electronic and propulsion skills are applied mainly to aerospace markets, not just on planes and missiles, but in air traffic control, and satellite constellations, and in communications networks. So this point is a positive and negative for me. I don't think that I've mentioned it on this channel yet, but I'm a big believer in Tesla, in large part because they're not super focused on one of their products. They're innovating on so many fronts, like electric automobiles, autonomous driving, solar energy, and are looking to get into insurance right now. All of these make the possible value of the company higher if they can capitalize on all the opportunities. But if a company remains super focused, like Raytheon Technologies is looking like it's going to be, it makes the likelihood of dominating that industry much higher than if they were juggling 5 to 10 different businesses like Tesla. The article continues. The underlying unity of the enterprise will enable Raytheon Technologies to offer its myriad products and bundles that competitors have trouble matching. For example, on a Boeing 787, it provides electrical power, environmental controls, fuel measurement, braking, displays, lighting, seating, oxygen, fire suppression, thrust reversers, and cargo system. On military missions like missile defense, the company can offer weapons, sensors, communications, battle management, and logistics. Now that is one thing that I like about this new company. They're super focused but can still offer a ton of different products to a customer. So if they convince a customer one of their components should be used, it's a pretty easy upsell to get them to bring on another and then another. It's the same thing with Apple products. Once you get one, you'll want another because they all work so well together. Same thing when you offer a bunch of closely related products like Raytheon Technologies can. Next, the article talks about the company's depth. Raytheon Technologies will have 195,000 employees, the vast majority of whom are highly skilled because production of commodity items was outsourced years ago. That includes over 60,000 engineers working at the cutting edge of aerospace and defense technology, often with high-level clearances in the case of military work. No other aerospace company in the world surpasses the new enterprise in the depth or breadth of its competencies. For instance, no other company has brought geared turbofan engines to market, a technology that is inherently more efficient than conventional turbofans. No other company has developed a fighter engine for the military combating the performance features and stealth of that of a F-35 fighter. And no other company in the defense sector can claim broader expertise in digital radar, electronic warfare, hypersonic weapons, and cybersecurity. A senior Raytheon executive told me this week that planners expect a rapid acceleration in innovation arising out of the new enterprise's technical depth and resources. And I think this is something that's kind of expected from giant companies like this. What these military contractors are looking for, especially in the United States where the budget is super high, is the best and the brightest. Now, I can't personally attest to the competence of Raytheon Technologies' workforce, but if they are really the best, like Forbes seems to think, that is probably the strongest argument for their long-term success. With the rate that technology is progressing, it's not about which company can market their supplies better or have the strongest patents. It's the company with the most innovative workforce that will succeed in the long term. So, good point by this author. Next on the list is diversity. In order to be a leading player in global aerospace, an enterprise needs to reach all major markets across the full breadth of the product lifecycle. It's not enough to be the original equipment manufacturer of world-class engines because most revenues and returns are generated in the aftermarket. And it's not enough to be a leader in military avionics because defense demand periodically turns down, usually about the time commercial demand is picking up. So I think the biggest thing about investing that almost anybody can benefit from is diversification. And the same thing goes for companies. I think right now, with the economy the way it is, a spotlight is put on companies who don't diversify, and those companies are really struggling right now. This is one of the things that I talked about in my Disney video about 2 months back. Diversity matters, and like Disney, who are in so many different markets, Raytheon Technologies is diversified in so many different parts of the same market. It may not even be enough to dominate the U.S. market for aerospace goods and services. Most aerospace demand originates outside the U.S., so economies of scale demand a presence in both domestic and foreign markets. When Raytheon Technologies states it has a balanced and diversified A&D portfolio, part of what the company is saying is that it operates successfully in diverse markets, commercial and military, domestic and international, original equipment, and aftermarket. That vast presence will allow the merged enterprise to smooth out revenues and returns despite the cyclical up and downs in each market segment. Now, as dividend investors, one of the big things you look for in investment is the ability to weather economic storms. When you're diversified like this, it allows you to smooth out these bumps in the road and continue to pay out steady dividends to your investors, even when economic conditions are not favorable. The last point Forbes makes is about their resilience. If an enterprise has scale, focus, depth, and diversity, then it'll probably have one other quality desired by shareholders and customers: resilience. Resilience has become a popular word in the Pentagon as military planners begin to grasp the challenges posed by a rising China. Many defense preparations that once seemed dependable, such as military space capabilities, now look vulnerable. Coronavirus is just the latest black swan warning to policymakers and investors that over the long run, only the strong survive. I think a lot of these terms thrown out by Forbes play off of each other because essentially, the depth, diversity, and scale of Raytheon are the reasons why this company will be so resilient. So with this point, the author's bringing us back full circle on why Raytheon Technologies will be a great investment. The enterprise emerging from the integration of Raytheon and United Technologies will be more resilient than either company was separate. Of course, it helps to start with solid building blocks. Raytheon was recently ranked by Forbes magazine as the most respected A&D company in the world. The combined enterprise will be even more formidable. And while business conditions have changed a lot since the merger was first disclosed, in some ways the changes make a more compelling case for getting together. Nobody was saying much about sector consolidation a year ago. Now, Raytheon Technologies may stand out as the first and best in a series of major consolidation moves, making companies more able to cope with difficult market conditions. In times like this, many companies will go bankrupt, and others will continue, but basically be a shadow of their former self. Being large and having such a strong, dominant position in the defense and aerospace industry could help the company get through this, and hopefully come out stronger on the other end as the dust settles. Now, I think that article did a very good job of summarizing Raytheon Technologies and the strengths that it carries. But another thing that we really need to focus on in this channel is the dividend history and the health. But to give a little context about what the stock is doing right now, the stock currently trades at about $59 per share, and over the past 3 months has really fallen from the highs at about $90 per share. This company has had 26 years of dividend growth so far, and yields 3.3% on your investment currently. They have a payout ratio of under 60%, which is ideal, because if earnings were negatively impacted by 40%, this dividend would continue to be sustainable in the short term while they figure their stuff out to return to massive profitability. Now, I think that this dividend should be pretty safe because of their industry, strong financial position, and the pretty good payout ratio. So overall, I think Raytheon Technologies is a very solid investment at this time, and it will have a place in my dividend investing portfolio, which I will be starting a weekly series on soon. I would say, given the current environment and their valuation, the stock, on a scale of 1 to 10, is a solid 8.5 to 9 for me. Now, as always, do your own research before you invest in anything, but that's just my opinion. So if you guys enjoyed the video, make sure to hit the like button, and if you want to make sure you catch my future uploads, subscribe and hit the notification bell. In a second, you'll see 2 of my other videos on screen, so go watch one of those, and I'll see you guys in the next video.